Hey everyone, financial freedom is here. Let's be honest. When it comes to investing, Warren Buffett is basically the god, the Oracle of Omaha, the guy who turned a few $1,000 into tens of billions. And you know what's crazy? He did it all by following the same set of simple rules, no fancy algorithms, no get-rich-quick schemes, just good old-fashioned value investing. And the craziest part is that anyone can learn to invest like him. That's why in this video we're diving deep into Warren Buffett's 7 golden rules of investing. We're talking step by step with real-life examples so you can understand exactly how to apply these principles to your own portfolio. Whether you're just starting out or you've been in the game for a while, these rules are timeless for a reason. So grab your notepad, get ready to take some notes, and let's unlock the secrets to investing like Warren Buffett. All right, let's kick things off with rule number 1, long-term holding periods. Now, Warren Buffett is famous for saying, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. I know. In the age of day trading and crypto pumps, 10 years can seem like an eternity, but here's the thing. Buffett isn't playing some get-rich-quick game. He's playing chess while everyone else is playing checkers. See, when you hold investments for the long haul, you ride out the short-term volatility. The market goes up, the market goes down, but over time, quality companies tend to grow. And that's where the real magic happens. Compounding is like a snowball effect. Your money makes money, and then that money makes even more money, but it takes time. Think of it like planting a tree. You wouldn't dig it up every few weeks to see if it's grown, right? You give it time, you nurture it, and eventually it bears fruit. The same goes for your investments. Give them time to grow and don't panic sell at the first sign of a downturn. Remember, Rome wasn't built in a day, and neither is $1 million portfolio. So be patient, be consistent, and let the power of compounding work its magic. Now let's talk about rule number 2, and this one is huge. Don't lose money. Sounds obvious, right? But you'd be surprised how many people forget this fundamental rule. Warren Buffett actually considers this to be the most important rule of investing, and here's why. Losing money doesn't just set you back financially, it messes with your mind. It makes you second-guess yourself, it makes you risk-averse, and it can completely derail your investment strategy. Think about it like this. If you lose 50% of your investment, you need to make a 100% return just to get back to even. That's a steep hill to climb. So how do you avoid losing money in the market? It's all about managing risk. Don't put all your eggs in one basket. Diversify your portfolio and only invest in things you understand. Now, I'm not saying you should be paralyzed by fear and never take any risks. Calculated risks are part of the game. But before you hit that buy button, always ask yourself, what's the downside potential here? Can I afford to lose this money? If the answer is no, then walk away. Remember, protecting your capital is priority number 1, because as Warren says, the first rule of making money is not losing it. All right, on to rule number 3, intrinsic value. Now, this is where things get really interesting because it's all about finding those hidden gems in the market, the undervalued companies that are worth way more than their current stock price. Think of it like finding a $100 bill on the sidewalk that everyone else is just walking past. So how do you find these hidden gems? Well, Warren Buffett uses a method called discounted cash flow analysis, or DCF for short. Now, I know that sounds intimidating, but it's actually not that complicated. Basically, you're looking at a company's future cash flows and discounting them back to the present to see what they're worth today. It's like having a crystal ball that tells you what a company will be worth in the future. Of course, it's not an exact science, but it gives you a good idea of whether a company is overvalued or undervalued. The key is to buy companies for less than they are intrinsically worth. That way, even if the market takes a dip, you know you've got a margin of safety. Think of it like buying a used car. You wouldn't pay sticker price for a car with a bunch of miles on it, right? You'd want to negotiate a price that reflects its true value. The same principle applies to investing. Look for those bargains, those companies that are trading below their intrinsic value, and that's where you'll find the real opportunities. Rule number 4 is all about staying in your circle of competence. Now, this is one of the simplest yet most overlooked rules in investing. It basically means sticking to what you know and avoiding investments that you don't fully understand. Just because everyone else is jumping on the latest tech IPO or meme stock, it doesn't mean you have to. Warren Buffett famously avoids investing in industries he doesn't understand, like tech companies in the early days. He sticks to businesses he knows, like insurance, consumer goods, and railroads. Why? Because when you understand a business, you're better equipped to evaluate its long-term prospects. You can read its financial statements, you understand its competitive landscape, and you can make more informed investment decisions. It's like the old saying goes, a jack of all trades is a master of none. Don't try to be an expert in everything. Focus on a few industries or sectors that you understand well and become an expert in those areas. That's where you'll have the edge. Remember, you don't need to be a genius to be a successful investor. You just need to know your strengths and weaknesses and stay within your circle of competence. Chapter 5, From Cigar-Butts to Quality Businesses, Warren's Evolution as an Investor. Now let's talk about rule number 5, don't buy cigar butts. Now, this rule is interesting because it represents a major shift in Warren Buffett's investment philosophy. Early in his career, Buffett was a classic cigar-butt investor, meaning he looked for deeply undervalued companies that were trading for less than their net asset value. He called them cigar butts because they were like finding a discarded cigar with one last puff left in it. You could get that last puff on the cheap, and it would be profitable, but it wasn't a long-term solution. As Buffett gained more experience, he realized that buying low-quality businesses, even at bargain prices, wasn't a sustainable strategy. So he shifted his focus to buying high-quality businesses with strong competitive advantages, even if it meant paying a fair price. He realized that in the long run it was better to own a great business at a fair price than a fair business at a great price. Think of it like buying a car. Sure, you could buy a beat-up old clunker for a few $100, but it's going to cost you in repairs and maintenance down the road. On the other hand, if you invest in a well-maintained car, even if it costs a bit more up front, it will save you money and headaches in the long run. The same goes for investing. Focus on quality businesses with a proven track record, strong management, and a durable competitive advantage. Those are the companies that will stand the test of time. Chapter 6. Be fearful when others are greedy and greedy when others are fearful. All right, let's talk about rule number 6, and this one is a classic. Be fearful when others are greedy and greedy when others are fearful. This is probably Warren Buffett's most famous quote, and for good reason. It perfectly encapsulates his contrarian investment approach. See, most people follow the herd. When the market is going up, everyone wants to buy, and when the market crashes, everyone panics and sells. But Buffett sees these moments of fear and greed as opportunities. When everyone is greedy, it often means that assets are overvalued and a correction is due. And when everyone is fearful, it often means that assets are undervalued and there are bargains to be had. Think back to the 2008 financial crisis. While everyone else was selling their stocks in a panic, Buffett was busy buying up shares of undervalued companies like Goldman Sachs and General Electric. He saw an opportunity in the chaos and took advantage of it. Now, I'm not saying it's easy to go against the crowd. It takes guts to buy when everyone else is selling and to sell when everyone else is buying. But that's how you find the best deals and generate outsized returns. Remember, the market is driven by emotions, and emotions can be irrational. So keep your cool, think for yourself, and don't be afraid to be greedy when others are fearful. Chapter 7. Seize the day. Why opportunity favors the prepared investor. And finally, rule number 7. Seize your opportunities. Now, this rule is all about being ready to act when opportunity knocks. Because in the world of investing, opportunities don't always come knocking at the most convenient times. Sometimes they arise during periods of extreme market volatility, like during a recession or a global pandemic. The key is to be prepared. That means having a plan, having cash on hand, and having the conviction to act decisively when the time is right. Don't hesitate, don't overthink it, just pull the trigger. Because when opportunity knocks, it doesn't wait around for you to make up your mind. Think of it like surfing. You can't control when the waves come, but you can be ready to ride them when they do. You can practice your technique, you can choose the right surfboard, and you can position yourself in the right spot. But when that perfect wave comes along, you need to be ready to paddle hard and catch it. The same goes for investing. Do your research, manage your risk, and be patient. But when you see an opportunity that aligns with your investment strategy, don't be afraid to seize the moment. Outro: unlock your inner Buffett 7 rules to invest like a legend. So there you have it, Warren Buffett's 7 golden rules of investing. We talked about the importance of long-term thinking, the power of compounding, and the need to protect your capital. We discussed the concept of intrinsic value, the importance of staying within your circle of competence, and the evolution from cigar-butt investing to focusing on quality businesses. And we explored the power of contrarian thinking and the importance of seizing opportunities when they arise. Now, I know that was a lot of information, but trust me, these rules are worth their weight in gold. So if you want to start investing like Warren Buffett, hit that like button, subscribe to the channel for more videos like this, and keep this quick summary on the screen for your own reference. It's a great way to internalize these principles and start applying them to your own investment journey. Thank you so much for watching, and I'll see you in the next video.